Welcome to the book, The Key to Wealth Building. The Guide to Your First 100.000, written by the writing investor. When following my guide, $100.000/euros within 10 years is absolutely possible. Chapter 1. Understanding the system. Let's start with a bit of imagination. If you're stuck in a mindset of scarcity and believe it will always be that way, then it likely will be so. However, many people have big dreams that feel out of reach. To make these dreams come true, some people need a lot of money to buy the experiences they want. When we look at the financial system, we see that it's not designed to make everyone rich. In fact, if we divided all the money in the world equally among everyone, each person would become a millionaire. But think about what that would mean for our world. No one would work, there would be no one to provide services, and there would be no food in the stores. This would make $1 million worth nothing. So, everyone being a millionaire simply isn't possible. That's not how the system works. The system is built so that a few people have most of the money, and the rest have to work for it. If you are a regular participant in this financial hamster wheel, you might feel stuck. Getting out of it takes a lot of effort, but it is possible. In this book, we will explore how to change your mindset, understand the financial system, and take practical steps to build your wealth. By the end, you'll be equipped with the knowledge and tools to achieve your financial dreams. You need to understand that the system is not designed for your benefit. Imagine you could earn $2 million in a week. You might think, great, I can retire. But that's not how it works. The system is built so that even if you work very hard, you only earn just enough to be happy and do what you want, so you don't fight against the system. The world is controlled by a few wealthy families who make sure the average person has just enough to keep going, ensuring the system stays intact. These families control how much money the average person has by manipulating interest rates. When people start becoming too wealthy, the system becomes tougher so that people keep working without realizing it. Don't think that the government is there for you. The government can send you bills whenever they want and spend your money however they choose. If they run short, they print more money or ask for more from you. This might sound harsh, controlling people, but remember, it's also necessary. If everyone could do whatever they wanted, the world would become chaotic, as mentioned earlier. Imagine you start a business today. You open this business in the current economy, which controls you and puts pressure on you. So you can't easily grow out of the system. The powerful people, let's call them that, make sure you don't become too self-sufficient because the economy or financial system must keep running. You get paid by others, and those people can only pay you with what they have left over. So, even if you start your own business, you're still stuck in the system. We can only earn money from the companies and people around us. If someone is just getting by, they're unlikely to buy your product because they simply can't afford it. Whether you're an employee or a business owner, we're all in the same boat. Everyone works for the same system. As I said, the system is there to support the government and keep the economy running, not to support you. If something bad happens, it's always the working man or woman who pays for it. Whether through insurance or taxes paid to the government, the working class ends up paying for all the mistakes, natural disasters, or when another war breaks out. Understanding this helps us see why building wealth and financial freedom requires effort and knowledge. It's not easy, but with the right mindset and practical steps, you can navigate the system and achieve your financial dreams. This book will guide you through understanding the system, changing your mindset, and taking the necessary steps to build your wealth and reach your first 100,000. Let's get started on this journey to financial success. Chapter 2. How do you break out of this system? As mentioned, the system is designed to keep you in it, but some strong individuals manage to escape. There is only one way: by having enough money to step out. This is possible only for people with a very strong mindset and drive. People who live below their means, invest, and save all their money. We will, of course, dive deeper into how this works. But should we want to step out of the system? Personally, I don't think so. Everything is connected, and we all play a part in something bigger. Helping each other is essential, and you do this by providing a service. I've learned that what gives a person the most fulfillment is helping others. So, instead of wanting to break out of the system, it's more important to realize that we are in it and work with it. Our financial system experiences tough times, and they will inevitably come again. To protect ourselves and others during these times, it's crucial to have multiple income streams and keep expenses low. That's why saving and investing are so important. To begin with, the first step is understanding. The second step is mindset. If you want to become financially powerful, you need to adjust your mindset. Chapter 3. Basic Principles of Money. Let's delve deeper into the world of financial laws and how money flows. As I mentioned earlier, keeping money stagnant isn't wise because of inflation. So, what is inflation? Inflation is the gradual increase in prices of goods and services over time, which reduces the purchasing power of money. Now, what should you do with your money? Your money needs to be active, and one effective way is by investing it. When you invest money, it becomes an asset. An asset generates income in various forms. For instance, you can earn interest, receive dividends, or benefit from increases in the value of your investments. These investments create passive income, which means you earn money without actively working for it. This continuous cash flow is derived from sources where you've invested your money wisely and it grows over time. Through smart investing, individuals can gradually accumulate wealth over time. You've probably heard the saying, the rich get richer and the poor get poorer. This is because those who already have wealth can lend money to others and invest it, thereby generating investment returns. However, if you don't have money to invest and rely heavily on loans, you're moving in the opposite direction. Loans often require repayment of more than the original amount borrowed, and when you factor in inflation, it compounds the financial challenges. As a result, the wealthy see their assets grow, while those without access to capital may find it difficult to break free from the cycle of borrowing without achieving financial stability. Understanding these principles and making informed investment decisions are crucial steps toward financial security. Now, let's delve deeper into the types of income mentioned earlier. Interest, dividends, and increases in the value of investments. Financial interest, dividends, and increases value. Financial interest. Financial interest, typically expressed as a percentage, is the extra amount added to a loan that borrowers must repay. For example, if you borrow 10,000 euros with a 6% interest rate, you owe 10,600 euros in total. 10,000 euros plus 6% interest equals 10,600 euros. This additional 600 euros is the financial interest, and it makes borrowing money more costly for the borrower. Interest serves as a fee paid by borrowers for using someone else's money. This is what makes loans appealing for lenders, because they earn extra money from lending out their funds. There are two types of interest: credit interest and savings interest. Credit interest is what you pay on loans, while savings interest is what banks pay you for keeping your money with them. When you save money in a bank, you're essentially lending it to them. The bank then uses this money for investments in financial markets to earn more money. Banks sometimes face shortages of money when many people want to withdraw their savings at once, like during the 2008 financial crisis. Banks now have rules requiring them to keep a portion of their money in cash to ensure they can meet customer demands. If everyone tries to withdraw their money simultaneously and the bank doesn't have enough cash, it can cause serious problems. Remember, the money you deposit in the bank isn't physically there. It's invested to earn interest and grow. Dividends. Dividends are payments made by companies to their shareholders. When you own shares, which are like pieces of a company, you may receive dividends as a reward for being a shareholder. These dividends are usually paid out regularly, like every few months or once a year. They're a way for companies to share their profits with the people who own their stock. For example, if you own shares in a company that pays a dividend of €1 per share and you own 100 shares, you would receive 100 euros in dividends. Dividends are a bit like getting a reward for owning a part of the company. Increases value. Increased value refers to the growth in the worth or price of an investment over time. When you invest in something like stocks, real estate, or even collectibles, the value of your investment can go up. This means that what you bought it for originally is now worth more. For example, if you buy a house for 200,000 euros and its value increases by 10% over a few years, its new value would be 220,000 euros. The increased value is the 20,000 euro difference between what you paid and what it's worth now. Increased value is a way for investors to make money when they sell their investments for more than they bought them for. Do you want to continue? Thank you for listening to the free part of my audiobook. Do you want to read the complete book? Please go to my Etsy page via the link in the description. And don't forget to subscribe and follow my channel for more books to come.